Hey, welcome back. Getting back to the sub-recommended stocks. Once again, I think there are quite a few interesting companies out there. I included Peloton even though it wasn't recommended because I really wanted to check them. I think they offer a very important lesson for the market, but more on that later in the video. If you have a suggestion, let me know why you think they may be interesting and I'll add them to the list. To begin with Canadian Solar, this had a very impressive rise a few years ago before crashing significantly. With solar power still having a lot of room to grow, this can be a very interesting investment. They produce solar panels, batteries and other products in that area, and they also develop solar power and storage projects. A majority of the production capacity is in China, but they seem to focus on bringing some of the production back to the US. Now the question is, can they do it not only quick enough to avoid a potential trade war, but also at a competitive price? With new tax credits and tariffs on China, they are investing quite a bit in the US. This obviously has an effect on the cash flow, but it can improve the overall long-term potential. I remember buying this for 12 or 13 like 7 years ago, but I sold it after I doubled my money. Now it's getting back to the same level, but things are a bit different. Financially, they are in a good position, with the current assets being almost enough to cover all the liabilities. The equity that would be left is more than twice the market cap, so the book value is pretty low. They don't have a lot of long-term debt, but they pay pretty significant interest because they use short-term borrowing quite a bit. I think it's a good thing to do now because that way they don't lock in some 7, 8, 10% bond for a bunch of years. Anyway, the net income is improving significantly, but due to the higher capex, the cash flow is negative. From a net income point of view, this is at a ratio of around 4, which is very cheap. So, from a price to earnings or book ratio, they are indeed very cheap, but if you look at them as if they were any other Chinese company, they aren't that cheap. After many years of subsidies, China started to cut some of them after becoming by far the #1 solar panel producer. Now, keep in mind that any subsidy is up to the state, and if they want to cut or completely stop them, it's entirely up to them. Not only that, but there is also a lot of competition plus technological advancements that you have to keep up with. A main attraction for me was that the founder proposed to buy it for 18, I believe, implying something like a 50% profit from when I bought. It was denied before I bought, but it still showed the potential value that it had. Now, the industry has a lot of potential, of course, even with high competition. The solar industry is estimated to reach 300 billion by 2032. That would be a compound annual growth rate of above 12%. Even a fraction of this market can warrant a 5 or 10 billion market cap, implying a 5 to 10x for Canadian Solar. So there is potential, but you have to take into account the issues. An issue with producing in China is that there is the risk of tariffs or any other kind of political issues. The US recently talked about raising tariffs on some Chinese products, including quadrupling the tax on Chinese EVs. This included some solar equipment. You can have any country in your name, but it doesn't mean anything for what you make in China. Overall, this is definitely an interesting company. It's risky, yes, and they can be in the middle of a trade war, but there is also potential. And as kind of a safety net, there is probably interest from the founder and they are in a good financial shape. I could see them as a 0 something percent of the portfolio, especially if they keep falling. With a new spark in the trade war, they might become even cheaper, but we have to balance the risk and reward. For me, this is on the watch list, but I want to see how they respond to the recent tariffs. Now, ARCC Capital, they are a business development company, or BDC, providing loans to middle market companies. The dividend is currently at around 9%, but if you manage to buy at some opportunistic times, it can easily be above 10, 12 or even 15%. Thanks to the higher interest rates, we see improvements in the net income and pretty much everything that they present. In Q1, they invested almost 3 times as much as a year ago, showing how much they can benefit from such an environment. They get this kind of a boost from high interest rates, but more on that in a second. Financially, they are in a good position, with the total assets being twice as big as the total liabilities. They have to pay around 1.5 to 2 billion per year in long-term debt until 2029, but it's very likely to see them refinance and push some of the maturities in the 30s. So overall, not bad. The issue with the balance sheet is that yes, you have equity pretty much equal to the market cap, which is great, but the assets are investments at fair value. If they have to sell them, it would be during a time with issues, meaning that the price they get can be 10, 20, 30% below the fair value, and suddenly the equity is a lot smaller. Now, a good chunk of their assets is in first and secondly unsecured loans, which are normally lower risk. But the thing is, given the nature of the business, they are very exposed to economic weakness. If there is a recession or any kind of economic issues, they can crash 50, 60, 80% or even more. Sure, then this could be a very interesting buy, but if you buy at the current prices, you basically bet that there won't be any issues with the economy. Another aspect is that thanks to the floating rate loans, they make more money when interest rates are high. This is partially one of the reasons why they went up lately. So they benefit from the current environment, but you also have to think about the companies that they lend to. High rates, high inflation, lower spending, not the best environment. So when the rates are cut, they would make less money, but on the other hand, there is more economic activity and the clients would be safer, so they can win from that side. For me, this is a stock that I'd really keep an eye on. If I get a once-in-a-decade opportunity in a recession or a weak economy to potentially lock in some 20-something% long-term dividends, I'd develop a position. If you bought in 2020, for example, you would have more than doubled your money and gotten like 80% in dividends. Now, Baker Hughes, this is among the largest oil and gas equipment companies on the planet. So think about all the essential equipment that basically allows the oil and gas industry to exist and also perform. They also go into hydrogen, carbon capture, storage and so on, and together with natural gas, they might have a lot of long-term potential. They can make from nothing to even more than 2 billion per year depending on the commodity cycle. They are investing a bit more than usual and there seem to be some improvements. The outlook is pretty promising and they seem to focus on improving the margin and the overall performance throughout the cycle. They target a cash flow conversion rate of more than 50% across the cycle, which together with the dividend policy is what you want to see. The distribution policy is a very generous 60 to 80% of the cash flow. This is ideal for let's call them a commodity company too, since they are very much related. So, as with a majority of commodity stocks, if you manage to buy them during the down cycle or in special events like in 2020, this can pay you a very significant dividend. Financially, they are in a very good position, with the current assets being enough to offset almost all the liabilities. Without a lot of debt, the interest is also very small. I think they are in a good position to even get into debt if they need to grow. By the way, you might see on some websites that they have diluted a lot, but in reality they converted Class B into Class A recently, and overall they actually bought back some of them. They are around the price from the middle of the cycle, but if you think about it, rate cuts should be beneficial and could boost them into the upper side. The role of high interest rates is to slow down the economy, which means theoretically less demand for oil. When they are cut, however, they can not only boost the demand but also help fund new projects, which would be directly beneficial for BKR. We can see the US consumption of oil around the middle of a cycle, and rate cuts should be the catalyst that could advance it. Currently, the low reserves suggest a higher consumption, which is expectable given the lower price. But I'd rather look at it from a long-term perspective. In, let's say, 2 decades, will the demand for oil and thus BKR's products be higher or at least the same? Probably not, but it doesn't mean that you can't make money with such an investment. There is potential, however, with the new energy sources, and they are trying to develop into that area. They can also be a long-term play on gas, which is overall more environmentally friendly and is seen as a transition from coal. They recently got a contract to supply the equipment for a big gas project in Saudi Arabia. Especially with Russian gas not being that appealing anymore, we might see a higher interest in this kind of projects. About a decade ago, a competitor was ready to pay like 34 billion for them, so pretty much the current price. It was blocked by regulators, and in the future this is unfortunately something that might prevent them from getting similar bids. I mean, who would buy them if not an oil and gas company or a competitor, which would lead to the same antitrust issues? Given the good financials and cyclicality, I'd say this would be interesting at like 10 times the average cash flow, so around 15 billion, meaning a price of 15. Coincidentally, that would also be the book value, by the way. There is potential and overall they look like a good company. Now, Peloton, this is a fitness equipment company that at some point was valued at over 60 billion. This is the classic Katie Wood stock. IPO around the beginning of the pandemic, she buys, people follow, and now it's down like 97%. If you bought when she told you, this would have to go up like 30 or 40 times for you to break even. And look, in my defense, I was against her even when everyone was praising, so I'm not following the trend of hating. The current assets cover the current liabilities, but the total ones aren't enough to offset the liabilities. A majority of them are in right-of-use assets and goodwill, so not really something they can sell if needed. That's an issue especially if they want to issue debt to grow, because the financial health is already bad. And another issue is that 100 million per year in interest for a company that's already losing money can rapidly spiral into a huge problem. Not to mention that this would have to increase if they want to issue more debt. Plus, the maturity of almost 1 billion in convertible notes is in less than 2 years, and I don't think the people who got them when the price was around 250 want to convert. There is a serious risk of them going bankrupt if they don't do something fast. They jumped like 15% recently when they announced that they plan to fire around 15% of the employees to focus on positive and meaningful cash flows. You know, it's funny that when a company like Nokia did this for the exact same reasons, they crashed by 10 or 15%. The issue is that it took an exceptional year to make like 200 million. Then they kept bleeding significant amounts of money, cut G&A expenses, had restructurings, impairments, fired people. But apparently they had enough to pay like 3 to 400 million in stock-based compensations, so a fifth or a quarter of the market cap. And all of that for what? To have the CEO step down? I hope a new CEO will turn it around, but that will take time and they don't even have a replacement yet. They talk about international growth, but how would they fund it? I don't think they can issue that many shares anymore because the value wouldn't be significant. There is potential to grow, but what makes them unique? You know, they aren't the Apple of fitness equipment. They offer nothing special that you don't pay for. Not having a competitive advantage and asking such a high price in such a saturated market is not ideal. Probably the only good thing I see happening to them is being bought by another company. They say that private equity companies are interested in them, and if true, if you bought at any point when Katie Wood told you to, that probably guarantees an 80-90% loss. Buying now can maybe result in a small profit, but if they don't find a buyer, you are left with a terrible company. Again, the classic Katie Wood stock, and I really hope that people stop listening to this kind of people. So overall, 3 interesting companies and a very good lesson. Let me know what you think about them in the comments. As always, what I cover in my videos shouldn't be enough for you to make any investment decision, so please do your own research before investing in anything. If you want to see more videos like this one, please leave a like and even a comment to help me out, and make sure to subscribe. Thank you for watching, and I'll see you next time.